Hello there everyone. Today's video we're going to take a look at the taxation of REITs. What is a REIT? Well, it stands for Real Estate Investment Trust. And this is a type of investment that is available on the stock market that you as an individual investor and shareholder can participate in. Particularly, have you ever wanted to be an owner of some large real estate in the centre of London? Have you ever wished that you could have a part share of a tower block of some famous landmarks in the city? Well, if you own shares in REITs, you can be. So they are a way for regular, normal shareholders to access what would have otherwise been inaccessible types of investments, because you can't just go out and spend so many billions on these properties, but you can certainly have a little slither of the action by investing in the REITs. Now, interestingly enough, the REIT regime in the UK, it's been in around about 15 years. The companies that own these properties, these different types of commercial and office blocks and skyscrapers, and goodness knows what, these actual companies have been in existence for years and years, a lot of them. But it's the regime that was changed around 2007, and these existing companies, which were often listed on the stock market, turned themselves into REITs because of the tax breaks that the government introduced at the time. Basically, REITs have been around in the USA for many years. It's another example of something that had worked elsewhere in the world, and the UK authorities said, okay, we like the look of that tax break and what it tries to do to encourage certain types of investment behaviour, and will adopt it in the UK. So the REIT regime's been in the UK about 15 years. So basically it's a tax efficient way for the actual companies themselves that invest in these properties to save on tax. And it's also an investment play for individual shareholders like you and I to get a slice of the action on these properties that otherwise would not be available to us. So let's just have a look at an example and some of the qualifying criteria. So I've just made up some numbers here, and this is a REIT, so it's a real estate investment trust. It's a company basically listed on the stock market, and let's say it invests in central London tower blocks, office blocks, and we've got three divisions of this company. We've got the rental division, so it owns, buy to let, as it were, but on a big scale. Buy to hold, it's buying, it's hanging on to large office blocks in London. It's making 500 million a year income. It's also making capital gains from selling some of these long-term investments. And you've seen my recent video on the differences between the balance sheets and the profit and loss and everything else on investment versus flipping and how we treat them. But in this example, assume capital gains of 300 million on these long-term assets that they've sold. So their profit from their rental division, 800 million pounds. But they've also got other stuff going on. They've got property management that they do. So they manage other people's properties, and they've got a turnover of 200 million pounds a year from that. And they've got a third division, which is property trading, so just flipping, short-term flips. And let's say they made 100 million on a flip. So they don't do two, they're mostly concentrating on the rental space. But they've got these three different things going on, and the top line from each of the divisions, 800 million, 200 million, and 100 million. And they've got some expenses associated with this. So let's say 100 million expenses for the rental division and 75 million for the property management, and a more modest 25 million of expenses for the property trading. So the profit for the three divisions within the REIT, 700 million, 125 million, and 75 million. Now the rules say that if the profits from the rental arm of the business are greater than 75% of the total profits of the company, which in this case they are, because 700 million is greater than 75% of 900 million, then the rules say corporation tax for these guys, 0. So that's terrific. So no corporation tax to pay. Because corporation tax, otherwise it's at 19%. So 19% of 700 million, which they would have paid if these rules weren't in. So this is why all these big PLCs that own great swathes of land banks in London and iconic buildings that you'll have known about, before this regime came in, they still own these buildings, but they all decided to convert, and they said, absolutely, we can re-engineer our businesses to make sure that we hit this criteria by, doing less of this stuff or spinning it off or whatever, but concentrating on this so that 75% or more of the portfolio income, profits derived from rental, boom, no corporation tax. So, in this case, no corporation tax, which means potentially there is more to pay out to investors. And indeed, potentially, again, it's one of the rules. So that's the first rule. More than 75% of total profits has to come from rental. And then, for this corporation tax also to be zero, they have to then pay out 90% to the shareholders. So in these numbers, yes, 700 million, no corporation tax, but they have to pay out 610 million to the likes of you and I, individual, what we call retail investors. Well, there can be large pension fund investors as well, but the point is that whoever is the investors, whoever they're paying out to, 90% has to be paid out. So they can only retain 10% of the profits from this particular division. So let's assume you and I are in receipt of income from a REIT. So we've talked about how the company's taxed at zero. The other divisions, by the way, are just taxed at the regular corporation tax rate. So now we've received some income from a REIT. It's called a PID, a property income distribution, a PID. And how that is taxed on us as individual shareholders is taxed like as if we had rental income in our own right. So let's say we've got no buy-to-let properties in our own name, but the only property play, the only investment that we have is through REITs. Well, what would happen is, on your tax return, the property income would get taxed on your marginal rate. So let's say you are a basic rate taxpayer and you're paying tax at 20%. The property income distribution, you pay tax at 20%. If you're a higher rate taxpayer, you pay tax at 40%, or an additional rate taxpayer, you're going to pay tax at 45%. So it's not taxed like a dividend would be taxed. So it's taxed at your marginal rate, whatever you are, the marginal rate that you pay. The property income distribution, the PID that you receive from the REIT, is taxed at that rate. Now, 20% withholding tax also applies. So when the company pays out, in this case, this 610 million to these individual investors, they have to withhold 20% tax that go to the individuals. And then what happens is you reckon up with HMRC on your tax return at the end of the year. So let's say in this case, let's take an example. So you've got someone who has received, let's say, £10,000 from a REIT in the form of a property income distribution. So they basically 10,000 has been paid out. But strictly what happens is that they've only received 8,000 of cash because the REIT has withheld £2,000. So they've got 8,000 in their hand. Now on their tax return, they declare the full gross amount. They say, look, here's my gross distribution from the REIT, £10,000, but I've suffered £2,000. But if they are a higher rate taxpayer, that means they've got to pay over another 20% because the gross amount is 10,000. They've already suffered 2,000, but they've got another 2,000 to pay. If you are higher rates, additional rate taxpayer in the 45%, then you've got an extra 25% to pay. So it's already, this has been taxed at source for some of your tax bill on the distribution. 20% has been withheld. Now, if you hold these shares in a tax efficient wrapper like an ISA or a pension, then these amounts are paid to you gross and there is no 20% withheld. So in that example, let's say rather than you as an individual holding the shares in the REIT and you receive the gross amount of 10 grand, but it's held in your ISA, then the ISA actually receives 10 grand. There's none of this withholding 2 and the ISA just receiving 8. No, the ISA gets the full 10,000, as indeed it would if it was held in a SIP, a pension wrapper as well. So the best thing to do, if you want to invest in these REITs and have a property play, is get them in a tax efficient wrapper, because then there is no tax. Not only is there no tax withheld, but there is just no tax on them because they're in this tax advantageous wrapper, the SIP or the ISA. So get them held, I would suggest, in one of those wrappers rather than individual name. Now, the REIT, like I said, it has to jump through several hoops, and there are a few more that I haven't gone into, but the main one being it has to have more than 75% of its profits derived from rental activities, and then it's got to pay out 90% of the profits of that division. But it can also choose to pay out a dividend on the rest of it. It doesn't have to. There's no such rules on how much it has to pay out for the property management or the property flipping, but let's just assume in this example that it does pay out something. So again, no such CT, corporation tax, breaks for the 2 divisions over here, pays corporation tax, and let's just assume it's left with after-tax profits of the property management business of 100 million and the property trading division of 50 million. So 60 million even, can't read my own writing. So, and let's just say it's got a dividend payout policy of 50%. So remember, for the rental, it has to pay out 90%. For the other 2, it can do whatever it wants, but just assuming it decides to pay out half. So 50 million dividend on property management and 30 million on flipping. So how would that look? How would that be taxed on you as an individual retail investor? Well, it's just taxed like a regular dividend. So other stocks and shares that you may hold in other FTSE 100 businesses or whatever, you'll receive dividends on those, and that is taxed at the dividend. The dividend rates of tax, you get the first £2,000 a year tax-free, and then if you're a basic rate taxpayer, you've got dividend tax of just over 8%, and then if you're a higher rate taxpayer, that dividend tax rate is just over 34%. So the tax rates for dividends completely different, as we've already said, to the property income distribution, which is taxed as if you had your own buy-to-let portfolio in terms of how that would have been taxed. So, but again, if you've got these shares in a tax advantageous wrapper like a SIP or an ISA, and there's no tax full stop on any of the dividends. But it's interesting how even though you've got shares in one listed PLC, it can pay out 2 types of distributions. One is a PID and one is a dividend, and they are taxed in a completely different way, as I've just explained. So just an overview there on the REIT regime, real estate investment trusts, which have been in the UK for well over a decade now. A great way for smaller investors, not institutional investors, but obviously they are open to larger players as well, but for smaller investors who want to get a slice of the action on the booming London property market. I mean, you can get REITs in all sorts of different sectors, but it's I would suggest that most people would access them for that play on some of these larger mammoth buildings and projects, particularly in the UK capital London. London prices over the years have just gone like that. Yes, you may have a few bumps along the road, but generally the real estate as an asset class has done very well over many years. I'm not giving investment advice here, I'm just saying historically what's happened, but this is a way to play that market. So hopefully you like this video. If you do and you haven't already done so, please do remember to subscribe, and as always, I'll see you soon.